All right. So in order for us to determine whether or not the facility or the location is always key, right? So what we do is we use a software package called Store Track. Okay. And we do is we go in and we type in the address and put that address into Store Track. And Store Track's not perfect, but it gives us a really strong understanding of what's happening. And then we could create a radius around that, right? So we can say it's a 3-mile radius, a 5-mile radius, a 10-mile radius, depending on what we're looking like.
Mhm.
A competitive product might be Radius Plus. That's another product that people could use to do this. Yardi Matrix has a version of this as well. Right. So those are products that you can use to get this type of information. And so what happens is in that radius, it tells us how many people live there. What's the projection of population changes over the next 2 to 4 years? How many square feet of existing competition is in that radius? So we call that radius a target area.
Okay.
Target area could be 3 miles, target area could be 5 miles, right? That's typically what we look at. So it also tells us what the trend has been on the rates over the last 12 months. So now we know how much competition there is, how much population there is, what the population change is looking like, what the rate trends have looked like over the last 12 months. Right? So that's a pretty solid group of information that's going to tell you, hey, how does this location compare to all of the other locations I'm looking at? So then we say, okay, if it's a dense population in a 3-mile radius, I want 50,000 people. In a 5-mile radius, I want 115,000 people. Right? If it's not that dense, you might end up seeing lower amounts. So that's how that goes. On a national average right now, there's about 7 square feet per capita in the country. Right? So if you had 100 million people, you'd have 700 million square feet,
Yeah.
right, of square feet of self-storage in the country, right? Like that's the concept. So when we look at that 3-mile radius and 5-mile radius, first thing we want to know is what's the square foot per capita, right? Well, if I've got a dense population of 50,000 people and the square foot per capita is below 3, I want to buy and build all day long in that area. It's a completely undersupplied area. Like we know that already, right? Like we know that in general, people are the same across the country. In general, self-storage is needed in general, right? One of the things that we also look at is how many rentals as a percentage of houses available or space available. How many of those are rentals, right? We want to be above 25% rentals. We prefer to be above 25% multifamily and 40 to 50% rentals. Right? Rentals do 2 things, right? There's always a transitory aspect to rentals. And so people need to move in, people need to move out. So that's a strong customer base. Multifamily is a really strong customer base because they need a place to store their skis and their bicycle, right? They're just different cycles, right?
Yep.
So that's like the underwriting 101 of does this location make sense or not?
Yep.
Right. So I don't know how far else you want to go with that.
No, that's good. Yeah, like that's the kind of stuff that I'm looking for. Those are the kind of metrics that, and I've heard stuff. I mean, I've heard similar guys consultants say that. So those are the things that you can red, yellow, green. Like if it's the square feet per capita is greater than what 7 or 8, like what's the number that it's just absolute no go?
13, 15, that's going to be absolutely no go. I mean, maybe, right? This is where you like, would I do 20? Well, yeah, if I'm downtown Manhattan, sure. Right? Because all we're now doing is that's supply side. What about the demand side? Then you got to be making phone calls, talking to people on the phone. Hey, do you have any availability? Nope. Do you have any availability? Nope. You got any availability? Nope. 20 feet per capita is fine. Right?
Okay, got it. Yeah, that's the other side of it is just
Yes.
yeah.
So what's right? When you're talking to your competitors and you're asking them if they have any availability and they don't have any availability, then you can increase your pricing because the demand's there, right? Like you can increase your price, they're not going to go anywhere else, right? Right? You can increase your pricing, and you can also build or expand.
Yeah. Is there any, other than just calling locations and getting a sense of what is there anyone that's tracking that? I'm assuming it's not.
Yeah, so this is more of a yeah, on a big level they are. So on a big level, um, like the senior level REITs, they've got that stuff dialed in pretty hard,
Yeah. Yeah.
right? Like they know the market's really, really good. So I think that, those companies that have, 1,500 facilities, 800 facilities, they really understand their markets, right? They're dialed in pretty tight, especially if they've got multiple facilities in, let's say, a 20-mile radius. They've got 4 or 5 facilities in that 20-mile radius. They really know how they've got that number dialed in pretty tight.
Yep. Got it. Anything else that you think are like the big ones that, or maybe stuff, maybe it's even easier said, stuff that you see other guys doing that you're like, oh my God, I can't believe they're doing that. Like they're amateurs, like the big mistakes that they're making.
Yeah. So, I mean, I think the realistic question is, um, are you like right now? I would say the things that have really come up in the last year, maybe 8 months, has really come around changes in property taxes and, more importantly, insurance, right, rates. Like, I think that people, like a newer investor would say, "Hey, insurance has always been this, property taxes has always been this. I'm gonna go ahead and and buy this and use those numbers." And I know because we get everything quoted before we get to the closing table, right? We know what all that's gonna be. And we have deals fall out because of insurance right now.
The insurance is too high. It's too high, and it just makes deals doesn't pencil anymore.
And before, insurance just used to be a pain in the butt, and now it's a deciding factor.
White pencil and
Right.
the certainty of where insurance rates will fall next year leaves you questioning the riskiness of it.
Yeah.
Right?
Right. So if we can make it pencil this year, like, hey, cut the price by 400 grand. Now we can make it pencil this year. But I mean, if rates triple this year, what are they going to do next year?
Yeah.
So that volatility, that uncertainty is not something I'm willing to put other people's money into today.
Yeah.
Right. I can't do that. Right.
And then we've kind of talked about it too, like, the whole the vertical integration or versus not. Is there a thing there or is there some nuance? I mean, you kind of mentioned it before, but it's like it just because you're not managing your own doesn't mean it's not good. Right. But
Right. So here's the thing that I think about vertical integration, right? Everything from construction through property management through, I mean, even if you're an insurance broker, whatever that is, right? Like there's the vertical integration aspect. If you're excellent at that role, vertically integrate because you're excellent at that role. If you have an excellent property management company, then vertically integrate that. If you have an excellent construction management process or construction company, then vertically integrate that, right? But I think that not everybody's excellent property managers. Like it takes a certain level of volume to have that capacity. And I was talking to Jacob Vanderslice with Van West was on a call today with Mike Klotnick and Scott Myers and some other folks. And he was talking about his vertical integration on the property management side. And it seems to me like they're really good at that. Like if you're really good at that and you've got that lined out, then yes, I would say great, do that. But if you're just going to be good, you know, hire and pay for best. Pay for best in class unless you're going to become best in class.
okay. Yeah, that's good.
Yeah.
And how about like other revenue streams or like is that stuff to look at that's in terms of the ability to sell boxes and sell other or like is that a factor of
Yeah, the biggest revenue streams that I see happen between a non-professional and a professional is late fees. flat out collecting late fees, right? That can be another 2.5% of straight out revenue that people aren't collecting. They just don't collect it. They don't want to be known as the greedy person in the whatever, like they're community owners, like they're all members of the same clubs and they go to the same churches. And why are you charging me a late fee? And like, this is like, there's an emotional attachment as if you're a bad person for charging late fees, right? So like they don't do it. And so like that's a major, major aspect. When you start to look at other sources of revenue, the second one and probably the biggest one that has the potential for the biggest impact is selling tenant insurance, right? And it's either tenant insurance or the tenant protection plan. And they're two different products. They effectively protect the tenant the same way, but they're two separate products. And a lot of people, a lot of tenants are like, hey, I don't think this is good. You're just trying to rake me over the coals for money. And there's an aspect to that it is profitable for us if they're buying the insurance from us. But you talk to the owners, right? The owners of facilities who've been hit by a tornado, right? Who've had a flood, who've wiped out things. And now you got a 320 customers standing there with their hands open, like, where's my stuff? And it's scattered all over a mile.
Yeah. Yeah.
Okay, I'm sorry, I can't help you. Right.
Yes.
The extra $12 a month might have been a good idea, right? Like, I mean,
Yep.
there's an aspect to it that you really don't get. And fortunately, we haven't had that experience, right? But when you have a building burn or something happen and somebody's not covered and they've lost like this, there's this like stark realization that it's gone,
Yeah.
right? And so there's a value that's real. Unfortunately, it happens on occasion, but fortunately, it's never happened to us.
And then is it usually like, is this the sort of thing where the owner could, like, if you syndicate a deal, self-storage deal, where they keep those late fees and they keep the tenant insurance, um, or
Like when you say they, who's they?
meaning like everything we just talked about, is that all accretive to the LPs because it's all top line revenue?
Yeah, it's all top line revenue, right?
Okay. So there's not guys that are somehow keeping it at the opco level, right? Because if you had an operating company and then, or even if you had a third party property manager where they're keeping, I'm assuming in that case, they are keeping some of it.
Yeah. So like this is how it happens. So typically at the large levels, you're self-insured. So you do create a captive insurance fund, right? And so you sell the protection plan, right? And you're protecting, all of this, you and actuarial and all that kind of stuff. And you collect all of the revenues and then you've got an allocation set aside for payments out, right? But we're not big enough. We don't have that size of volume, but that's typically what happens. So Extra Space, I'm sure, does it that way. I'm sure Public Storage does it that way. Sure, Storage Asset Management, they do it that way because they have the ability to be best in class in that kind of concept and keep all of that risk on themselves, right? They have that ability. All right. So I would love to do that. I would love to have a captive insurance fund. I'd love to have enough volume in portfolio to do that. I just don't. So there's other companies that do that. That's what they're called. They're insurance companies, right?
So
So
you collect something for the tenant and you get basically a scrape or a off of that.
yeah. So typically what's happening, so like the worst company in the country is Extra Space. They keep 100% of all the tenant insurance fees, right? So if they collect $10,000, or let's say they collect, they could collect 10,000 a month, right? On a larger facility, they collect 10,000 a month in fees. They keep all the fees, right? In other places, we may get 50% of the fees, or we may get 50% of the net fees. So let's say the cost is, let's say we sell it for $12 and the cost is $3. So then the net gain is 9. We might split the 9. Or if the cost is 12, we get 6, and then the property management keeps the split between the two. Or vice versa. We get 6 and pay the cost where the facility manager gets the rest. That's a negotiable, with the exception of Extra Space. They won't negotiate it. They're 100%. This is the way it is.
Okay.
So,
And how about like the different types? I mean, you've got these self-storage that are just old school metal, 3 rows, no paved, no pavement. It's just gravel roads, and it's like they just, if as an LP, I mean, not all the deals are created equal, right? So like how do you guys classify that? I mean, you've got indoor storage, you've got
right.
temperature controlled storage, you've got, how does all that work?
You've got, you're going to go class A, B, C, and maybe D, but we don't really play around with D. All right. So you got class A, B, C, and D type of facility and A, B, C type of location, right? Because location is equally as important as quality. Bad location would be a dark, heavy industrial, hard to reach, out of the way facility. Because people got to drive through this dark back alley thing to get to your facility. They don't want to go there. They don't feel safe getting there.
Yep.
Right? Bad location, right? Top quality facility, bad location, not doing that. That's not good at all. All right. So you're going to start with the location. Say, is this an ABC quality location? Right? Even though it's got a high traffic volume, it's the highest crime area in the country. Like, don't do that, right? Like, that's like that. Like, people don't feel safe going there, right? Safety is by far the single most important deciding factor, other than, before price, right? Price is always the last most important thing. It's always the last most important thing. If it's too far away, I don't care what the price is. If I don't feel safe, I don't care what the price is, right? If I've got to go upstairs and there's no elevator, I don't care what the price is, right? Like, price is always the last important thing. Good. Right. So safety by far is the deciding factor, is one of the primary deciding factors in every scenario.
And that means, so that means the area, the neighborhood that it's located in. And then it also means then what? That it's gate coded, where you have to punch in a code to go in.
It could be. Depends on the area, right?
Right.
Like, if you've got a nice facility, and there's a lot of facilities around this country that don't have gates or fences, because the communities in the areas are not, that nobody's afraid of anything. It doesn't matter, right? That's you stop the community. They don't do that, right?
Okay.
So that's fine with them, right? So we've had a number of facilities that don't have any fences. Nikki, down the facility we just locked up, does it have gates? I think it does have a gate.
It does.
Right. So we've had some that have gates, but no fences. Right. But because there's a ditch, you really can't drive into it. Like, people can't get in there to steal the stuff. So safety doesn't just refer to, do I feel safe there? Do I think my stuff is safe there and it's not going to get broken into and robbed?
Yes.
Right. So it's the two factors, right?
Yep.
That's hard to quantify.
Yeah. Yeah. That's right. But yeah, it's just, and it's more goes, like I said, like the quality. So, but I mean, once again, I mean, these are things that are important because they're important to the consumer.
Right.
Right. So that's, yeah,
Well, and that's who we're serving. Like, if we're serving anybody, it's them. Right.
for
'Cause
sure.
if we don't serve them well, then we can't serve investors well. Like, it just can't do that, right? You have to serve the customers well in order to serve everyone else well, right? That's how you serve the banks. That's how you serve investors. That's how you serve the contractors. That's how you serve everybody else, as you serve the customer well. You'd ask something that was interesting. I want to make sure I touched on it. You're going to have, in self-storage, you're going to have facilities that are Class A. Like, we build Class A, top of the line, high quality, best in class, 800-pound gorilla in the market. You hate it when we come to market, because we're going to dominate. Like, nobody's going to compete with us, right? Like, that's a product that we'll build. But we'll also buy that gravel in the drive, that's got an older rickety gate, we'll always put in better cameras and lights and that kind of stuff, but it's an older metal type of drive-up facility. That's a perfect facility as well. You just need to know that when you're the 800-pound gorilla, you can drive rates. You control the market, right? But when you're not that person, you need to know where you stand in the pecking order, because there's an upper limit that you can charge. Like nobody's gonna rent at $120 a unit from me when they can get it for 95 from the Class A facility down the road. It's just not going to happen. So you got to understand, especially in the underwriting process, what your upper limits are, right? You got to know what that is, and if you don't, then you're not underwriting well.
Okay, so then that brings me to, so you've got the notion of, because I'm trying to think of someone who's trying to buy a facility that doesn't know what they're doing, and therefore then they're a couple things. They're overly aggressive on absorption rates. So meaning I'm buying this facility, it's half vacant, and I'm gonna somehow get it to 100%
Yep.
occupied in 12 months. And then the other side of that is they're coming out and saying, I'm gonna bump rents from 95 to 130. So what would be obnoxious on either of those?
Well, I mean, both those are just fine. I mean, we would buy those like that. We see those, like we underwrite that, and those are both real. But if I'm going to go from 190, if I'm going to go from 95 to 130, right? Let's pretend that's what I was thinking. And then I go and I look, I do my market analysis. And the great thing is when you buy these reports that come out of these, they tell you what all your competitors are charging, right? It's like, hey, here's the rates that are being charged today, right? Here's the average, here's the upper, here's the lower, like here's what it is, right?
So if an investor, I want to see that report.
That's how you want to be. You want to be able to see that report and go, okay, how is it that you think you're going to get to 130 when everyone else, like literally everyone else, is at 120 or below, and you're not even best in class in the area,
Yeah, yeah.
right? That's like you can't do that. It doesn't make any sense. You're not being realistic with the expectation.
Yeah. Because the other one on the absorption rate thing, because if you guys build a brand new facility, let's say it has like 700 units or something,
Right.
it takes, correct me wrong, but it takes a lot longer to rent those units out than most people think, correct?
Well, I mean, not if they're professionals. The professionals, then they know how long it takes. They're not coming in blind.
How long will it take? You got to like, what it just, like, let's take a Class A, big facility. I mean, I don't even know.
Yeah.
700.
Yeah, 700 units is fine. That's good. You're talking 80,000, 85,000 net rentable square feet. That's a big facility. It has to do with two things. Is it decked or is it solid? If it's all flat, right? So first level units always rent for more than second and third story units. Like if you got to get into an elevator, you're taking a discount. Right? That's just the way it is. Doesn't matter if it's 2 stories or 4 stories, like you still got to go up. It's just whether you push the button or not, right? Like, so you're going to take a discount if you have to go up, right? So if it's all flat and it's all enclosed, that enclosed could be a problem. You've got a certain percentage of our customers who want to drive up, unload their HVAC, unload their plumbing supplies, and put it in there. They don't want to go into a building, right? So like you got to understand what your customer base is. But let's pretend it's all enclosed, it's all Class A, it's all temperature controlled, it's all that. If you're in a kind of 6 square foot per capita market, you're going to have to try and buy the market. We're going to give you first month free and 20% discount for 2 months, 3 months. We're going to give you 2 months free. Like you're going to try and buy the market because you're going to try to get market share. You're going to drive pricing down in order to do that. That's going to take you in this realm. We're going to talk about 19 months is kind of a number that we look at a lot, right? That like we look at absorption in 3 states. Absorption to break even for operations expenses, absorption to break even for debt service coverage, and that could be at 1.0 or 1.25, depending on what your covenants are, right? And then stabilization at that 85 to 92% stabilization rate. So for us, we want to get to break even of DSCR 1.0. Like that's like when you're at DSCR 1.0, you are the facilities, you're no longer burning cash, baby, right? You're at break even. You're now, everything from there is moving up. So like that's a key number, right? So in 19 months, maybe 36 months, when you're looking at getting to 90% occupancy kind of concept.
Got it. Yeah. So 90%, 19 to 30, could be up to 3 years. So yeah, the main thing is try to ferret out when people are being overly aggressive with those, so that'll make it look amazing if they say they can.
Well, yeah. I mean, the reality, and there are some operators like who are really good, who say that they can absorb to they can absorb to 1.0 DSCR in 6 months. I'm like, great, man.
But
Right.
yeah, but the number of people who do that, that would seem suspect. You want to see it with your own eyes, sort of thing.
I would want to see it duplicated time over time over time, because I can buy a facility in a deeply underserved area and I'm going to absorb very fast, right? If if there's 2 square foot per capita and I build 80,000 square feet, I can absorb really fast in that area. I don't need to do a deep discount in the market. I just need to blitz market so that everybody knows I'm there, and I'll absorb. And then you'll market to out, right? Because in an underserved market, people are storing their stuff 20 miles away. But you gotta let everybody know in a large area that you're there now, and they should move their stuff to you, right? Because it's more convenient for them.
Right. So that's your big thing. When you see a deal where the square feet per capita is super low, that's just like winner chicken dinner.
Right, right. We really wanna understand that significantly better. Like, we gotta understand what's going on there, right? Now, if there's only 10% renters in the market, I'm gonna be like, "Okay,
Yeah, is
probably already stabilized for that area."
and yeah, there's a reason why it's so low because everyone got garages and yeah. Okay. No, this is super helpful because these are the things that I can craft as questions, and then I'll probably have to bounce more off of you to get just thresholds and tuning it in. But I mean, that's the idea, right? Is I mean, of course, one, then it's like syndicators and operators putting this kind of information in their deck so that the LP can go, okay, here's that metric,
Right.
and go and plug it in and have it be like, okay, well, that's yellow, that's red, mine, a closer look. Because like, the example you gave is like, well, the demand is really strong, but it's at, 20, um, square feet per capita. It might show as red, but it's just then next question is sort of the demand side, which could offset it. I mean, that's what we're trying to do is just like, hey, you need to dig into this more. This seems a bit out of range.
So, typically, especially if we're building, we do a feasibility study, right? We have a third-party feasibility study company that does the feasibility study for us, right? And so that's, $6,000, $7,000, and they typically send somebody out there, fly out, visit all of the competitor products, gets a feel for all of that stuff. They do stuff online, right? They do some real due diligence on that to help. I mean, it's a third party validation that we pay for. So you got to always be suspect, right? When somebody says, "Hey, I paid for this report," you know, how often do you pay for a report that comes back and says, "No, you shouldn't do that," right?
Yeah.
Well, hopefully enough times it's happened, right? Hopefully you've had enough times where a feasibility report comes back and goes, "No, you shouldn't do that." Like, because then that feasibility study company is doing their job, right? They're trying to protect you, right?
Yeah. Yeah.
Right. But they don't get paid again and again and again if they send you reports that
Yeah.
right. So it's like a pray.
Like, or just validating what you think it is, it's just having someone else sort of echo back what
It's
you.
what I mean. We definitely, when we talk to the feasibility study companies, we're like, listen, we need you to be realistic about what's happening here, right? Like, this has got to be realistic. You can't don't just parrot back to me what I'm telling you, right?
Yeah.
Right. Then I'm just paying for third party validation, and doesn't sit well with me, right?
Right. Yeah. Yeah.
So
Yeah.
okay.
So
And so in that model, there are some of them when they give back they have this standard litmus test of things, and they do green, yellow, red on them. And then they just explain it. They're like, hey, here's why this is red. Here's why this is green. And here's what we would say. We think that this area, like we had one come back on a deal and said, hey, we think that it's oversupplied. The demand is super strong in this thing. But if you build climate control, it's super underserved and it's an amazingly strong area. Right. So what are we going to do? We're going to build it 80,000, 60, it'll be 80,000 gross square foot climate controlled area in that area because that's the need. Right. I kind of knew that, but he identified it and like hammered it home.
Yeah, that makes sense. In terms of like the debt that you can get on these deals, let's just say an in-place deal, not like a development deal. What does that look like in terms of good debt versus bad debt? Rates, terms, length, size, IO.
Right now we're buying a facility and we're buying it for 2.1. It's got $500,000 of 504 SBA on it at 2.5%. So we're going to assume that, right? Like that's a little bit of a gem that we get a fine. So we need $1.5 million in debt. We found $500,000 at 2.5%. Like I'm going to take that, right? Like that's like you wouldn't normally know that until you really had the deeper conversation about all of those things. These are the questions that we ask. Like we're like, hey, what's the type of debt you have? More importantly, who's the bank you're working with who already has this debt? Do they want to keep the facility? Right. So if I talk to the banker, because I want to get permission to talk to the banker, right? If I talk to the banker and the banker doesn't want the facility, I want to know why.
Right.
Right. Like this is firsthand, third-party validation that there's something wrong with the facility that I don't yet know. Right. Like, so that's important to me. Right. Secondly, when I'm finding, because you got to find regional banks that are going to do this. You can find brokers and that kind of stuff, but typically it's a regional banker who's going to do this deal. They're tough to find. I mean, I used to be a banker, so it's easy for me to vet bankers fairly quickly. But in general, you talk to a loan officer and you don't know what you're doing. They're going to get you 80% on them. They're going to do that. No problem. Guaranteed. 2 months down the road, the loan committee comes back and says, we can do 50%. It's because the bank doesn't know what self-storage is. So I even had this happen to me here locally. A friend of mine who I've known for 20 years, right? And he was a senior presidential level kind of executive in a bank. And he's like, hey, this is what we're doing. We would like to do this. And I forgot to ask him the general questions that I ask, which are, how many facilities have you personally done? And how many facilities has your bank done in the last 12 months?
Yeah.
Right. And when the answer is none, I already know this is a no-go. Because if the bank isn't doing self-storage, they don't already understand the value proposition that self-storage brings to a bank. Right. So like when I get on the phone with banks and we'll have to do that, we'll either I'll do it or somebody in the company will do it. Right. Call the banks, call local banks. And there's I can share it with you. It's a group of small banks that are all part of an association, right? So you can look them up online. You can say, give me all the banks in 25-mile radius of this facility. And you can just call them all up. Say, hey, do you guys do self-storage? You self-storage, right? Like that kind of stuff. So you find the local banker, find brokers that we're working with. We work with them. This is what we're seeing today. Right now, we're seeing 65 to 75%, depending on the size of the loan. The size of the loan and the overall existing cash flow on the facility. Right.
Yep.
That's the percentage we're looking at right now. And right now we're looking at about 7.25. Right. I mean, you might get down to 7, maybe 6.85, but really 7.25 is that right now. We're seeing that today.
Yeah. And it sounds like for most of you guys, when you're buying this stuff, it's going to be local regional banks that are doing the first.
If you're working with a broker, the broker's going to find a local regional bank. Because I'm telling you what, on these smaller deals, on a $1.5 million deal, especially if it's got an SBA wraparound on it, what broker wants to deal with that? Nobody. The only bank that wants to deal with that is the ones in the backyard.
Yep. Okay. So yeah, that's harder than self. That's harder. Like you don't have as many options.
They're small dollars, right? Like a banker wants to be able to drive and touch the things they're lending on, right? At these dollar amounts, right? If you got a $300 million loan on a casino or a construction or like on these bigger deals, like you're going to fly to go there, right? You're going to go touch that thing. Well, the local bankers need to be able to drive. They want to drive they want to be able to go there and back in a day. That's in general what the rule is. So they need to go touch the facility because at the end of the day, if it goes sideways, they need to figure it out. And the issues that we run into is we don't live there. So how do they lend to us who's out of market? The only way they do it is if their asset is in their market.
Yeah.
Yeah.
Got it. Yeah. So that's your strategy. Like, what if you do one of these bigger facilities? Is there any other options to go to?
Well, yeah. I mean, there's some bigger. There's a few different ways. Like you could do a construction loan from like a bridge type of company, a pref type of company. They do construction loans, 10.5%. They'll do it. That kind of stuff. You could do a construction loan. But typically, we find a regional bank in that area who's going to do construction to perm, any perm type of concept, right? They may want to wrap it all into one loan and say, hey, here's what it's going to be. And then when you finish construction, you get C of O, here's what it's going to be. They want to wrap it all into one. Sometimes they want to say, look, here's a construction loan and here's this. But banks typically, like regional banks, don't like doing construction loans if they're not going to get the long-term permanent loan.
Right.
Right. That's the need of the banker.
Yep. Got it. Well, this is super helpful. Is there anything else you can think of that's like self-storage DD 101 that?
Yeah, the EPA is a big deal. Like if phase one's not been done on the project, you got to know that that's got to be done. Right. And so that's money you could possibly lose. Like you're going to spend $4,000, $5,000, $6,000 on a phase one. And if you don't do a phase one, fine. It's like a heroin person doing it with AIDS people. Like, I mean, yeah, you're taking risks like that. Like,
Okay, so that's a big deal.
yeah. And EPA phase one is like a major deal.
Any other thing like construction materials? Like, I mean, are people because most of this stuff is all like metal. I mean, like if you run
Right. You don't have any of that. You remember back, there was the whole slew of houses that got built with that Chinese sort of drywall that had like mold buildup on the inside, and it was like a catastrophic event, right? Like, so you don't have that. Like, there's like you don't typically have that kind of stuff because it's either cinder block, right, or it's this. Now, I mean, they're from a due diligence standpoint. If I would say, if you're looking at a Class C property that's on gravel, you got to make sure that all of like sometimes you'll find a facility where the support posts, their wood, were actually like in the ground, like a deck, right? With concrete around them.
Yeah.
And it's gravel or dirt on the inside. Like you got to know that's a rot waiting to happen, right?
Okay, got it. So there are some of those issues. Yeah, that could be really expensive if it gets out of control. Yeah.
So yeah, I mean, it like a good example. We bought a facility in Tennessee. Seller said, yes, the doors are fine. Like, okay, great. Like you said, all of the doors were fine. So we believed you. So we do a site visit, right? Well, all of the doors are not fine. They're all of these older garage doors, like the wooden ones that go like this, and the bottom two slats are rotten. Like you could stick your foot through them. Like they're all rotten.
Yeah.
So like, look, we got to replace 107 doors. If we can't buy this facility, we need to take a discount. So we took like $100,000 discount or something like that. And we replaced all the doors, right? But it cost us $86,000. We made a little money on the delta between the two, but we ended up with a higher quality door. But we had 3 or 4 people say, hey, you guys stole all of our stuff when you changed the door out.
Right.
We're like, okay, well, I'm glad we use best-in-class operators who, when they come replace doors, videotape every single door they replace, from cutting the lock to shutting it and putting it down. So we've got all of the video. You tell us which day it was, what your unit was. We'll sit down and watch the videos together. You tell us what was stolen. Right? So if you don't work with best-in-class type of operators, if you're just working with the Joe down the the road who's going to come and replace the door, then you don't know what you don't know that happens, because all sellers lie, all customers lie. Like, you got to know all of these things are lying, and you're the lie detector. You have to figure out where the lie is coming at you. Either it's overt, like the guy saying, "Oh, the doors are fine." Like, they're not fine, like by anybody's standpoint. And by $100,000, you agreed they weren't fine. To, hey, you're right. I guess I just didn't think about it that way. I didn't see it that way, right? So,
Yeah.
like, if you're going to buy and sell storage, you have to work with an operator. You got to be an operator who goes to the facility, who smells the manure that you can't see in pictures,
Yeah.
right? There's an ammonia plant upwind from you. Well, yeah, I mean, you just lost a major aspect that you didn't see because nobody went there,
Yeah.
right? So, like, you gotta know, right? You have to go.
A quick question. How much it would be to build a Class A versus Class B type of storage facilities? Earlier you mentioned that Class A is really good. Yeah. Per square foot construction cost for a Class A style versus Class B.
Right. So, if you're building,
Mm-hmm.
I typically don't build Class B, right? So you think about it from maybe different characteristics. I'm going to build good quality product, but it's not going to be climate controlled or temperature controlled. It's not going to be have an indoor. It's not going to be have maybe concrete through the drive aisles, right? It's going to be gravel, right? You're gonna say, look, I'm taking this and I'm dropping this down to a specific type of customer, right? Typically, the majority of people who are going to drive on gravel to get to their facility, who are going to go ahead and store their things in a non-temperature controlled place, it's a specific type of customer, right? So, that's what I want to make sure. We're not talking about quality of material or quality of workmanship. They're both good quality. It's just a different type, right? When you're building a Class A type of facility that's going to be bought by a larger REIT, right? So typically you're going to build 65,000 net rentable square feet or higher, because that's what a real estate investment trust is going to buy. They're going to want the Class A climate controlled, temperature controlled type of product. That's what their appetite is for. They typically aren't going to be looking for, but they will buy, right, this other type of product because it's not as versatile. Okay. So when I'm thinking about it, I'm thinking about what's my exit strategy on this specific style of facility. And if I'm building, I want to offer it up to people who are willing to pay a higher rate, right? They're going to pay me more money. They may pay me, like, the best deal that was done in our group, right, was we sold at certificate of occupancy, no customers. We thought we would sell at 17.8 million when we were stabilized. We sold at 18 million with no customers, right? Because that was 2020 and everybody was crazy. They were paying high money for everything. It's not happening again right now. But had we not built that quality of product, it wouldn't have paid that price, right? So I don't know, Sridhar, does that answer your question? Or
Yeah, that answers the question. Like when I say Class B, that's what exactly I meant. It's not the fancy high-end type of thing versus the workable solutions usually you see in non-metro areas, right? With all those other things, so the metro areas versus non-metro areas, that's what I'm looking at. Yeah.
So there's a company called Tracte, Trachte, Tracte. They really identify themselves as this Class B type of builder, right? They sell, it's almost like a kit in a box, right? And then they'll identify a vendor in the area that can build it, right? And help, line up the contractors. So you can play a part of it. They can play a part of it, right? They can do like a turnkey type of model for you. I've never used their product, but we've looked at buying their products. As a matter of fact, Are we buying one right now? Is that a Tracti building? Anyway,
I don't think so.
so yeah, we've looked at there's some solid buildings. I know we have Tracti building in Illinois. I know we've got one. At least one of those buildings is a Tracti that we would in. So I mean, it's a solid type of product, right? But it's got a wood. It's got like wood trusses, right, in it. That that help support the roof, right? That's maybe not something that some people would want in some parts of the country. How are you separating the walls? Are they a metal wall separator, or is it like a stick frame with drywall separator? Um, One of the things that we like is if you've got a building that's got a 10-foot by 10-foot and a 10-foot by 10-foot with the doors on the outside, then you want to be able to have a metal wall in between, because maybe you want to take that wall, disengage it, and fold it back and have a 10 by 20.
Okay.
Right? So like there's some design function that comes into play when you're thinking through some of these, especially when you're dealing with 5x5s or 5x10s. Those are crazy little wonky ones.
Yeah,
That's something else I wanted to say, Lance, is one of the I don't want to call it a trick, because I don't think that people are maybe meaning to be tricky when they do this, but you design a square building and that design has X number of whatevers. Like when we convert, like when you convert a building, it's not square typically, and you've got these wonky corners and you got to do stuff. So you put a 5x5 over here and a 10x5 over there, right? You're trying to get as much maximum use out of that facility, because there's a number. Like if you've got 100,000 square feet in the building, what percentage is net rentable? Well, if you've got 52,000 net rentable in a 100,000 square foot building, I know you got a ton of columns and there's some major problems in that building. Its design flow is horrible. But if you've got 86,000 net rentable square feet, I think, man, it's flat, it's open, and you've maximized every single thing you could do, right? So you're looking at the 73, 77% like number that's really strong in usage, right? Because you've got hallways you can't use, an office you can't use, bathrooms you can't use. Those are all not rentable, right? So what happens is you have a designer who designs a bunch of these little 5x5 units. So you look at the number of units in that facility. You may have 320 kind of 10x10s and 10x20s and some 15s or whatever. And you may have like 100 5x5s. And what they're doing with that is they're either trying to maximize total usage and therefore show a higher percentage of usage by square foot, right? That's one thing. Or they're trying to show a larger number of units that are coming up. But this is where the failure really comes. And this is where a novice investor would miss this. If you got 100 out of 800 units that are 5x5, there's no way you will ever rent all 100 of those 5x5s. Never going to happen. Okay. But a 5x5 unit may rent for $2.50 a square foot. Right? So now you've got all of these 5x5 units that are identified as renting as $2.50 a square foot, where if you had them as a 10x10, that might only rent for $1.20 a square foot. So you've got all of this square footage that you're never going to rent identified at $2.50 a square foot, and therefore push up your overall gross potential rental income. And that is a flat out lie. And a novice investor would never catch that.
Okay. That's a good one. That's the stuff I'm looking for, because see that stuff where someone goes in and they think, oh yeah, I mean, I'm going to go and I can jack the rents there. But you're telling me of those 100 units, you're going to rent half of them maybe.
Yeah, it's similar to in multifamily also. If you put all single family unit or studios, per square foot rent seems to be very high, but at the end of the day, it's tough to rent all of them in a single family or studios.
Yeah, that's one. So someone's presenting it, makes it look.
Yeah, I'm looking to buy my first one, so I think I would take your help.
Well, yeah, if you're looking, just let me know and I can we've got the tools. We can help you. My guess is you've probably done a good enough research where there's nothing glaring that's going to jump out at me, right? But we could look at some details and get a feel for it. The other thing, Lance, you didn't mention is, but the cost to build is different, right? It's not the same to build in, kind of the Northeast as it is in maybe the Southwest, right? It's more expensive in San Diego than it is in Mesa. Well, maybe not Mesa, but than it is in New Mexico, right? Right. So it just depends on where, like Southern Texas, you've got a lot of people who are coming across the border. We've got a lot of skills, great quality. They're working with a company that's paying okay rates for them. The overall quality is great. The insurability is great. All of it's great. Just the cost of labor is less than it is in Northeast.
Yeah, when I put the questions together, I'll shoot them to you so you can think of anything else. Yeah, I want to get. I think because right now to me, I mean, it seems, and you guys tell me what you think, but I mean, multifamily is still the king. I think in terms of just interest from LPs.
Yeah.
But I think self-storage is probably number 2.
Yeah. I mean, the thing I like about multifamily is it's a primary human need. You gotta live somewhere, right? Transportation, textiles, food, shelter, like these are primary human needs. You gotta have them, right? Right. And I think in general, across the country at least, but in general, I think we're undersupplied still, right? Residential supply is low.
Oh yeah, no, we definitely are. Yeah, there's no question about. Yeah,
So I would just say targeted multifamily, right? For the area. Like it's got to be a localized decision, right?
yeah,
Just like
for sure.
self-storage, right? Yeah.
But that's why I say like just LP appetite is the highest for multifamily, and I think appetite for self-storage seems, I put it second.
Why do you think? Why do you think the appetite in the LP communities that you're talking to um, are interested in multifamily?
Well, I just can because it's easier for them to understand and they've had enough exposure to it, right? So I think it's just like they've all lived in an apartment and there was just a whole multifamily love fest for the past 7, 8 years, right? Where it just was multifamily is the greatest thing since sliced bread, and that's all you hear. So I just think
Right.
that's my observation. So most people are like, it just if you ask them and they're going to consider investing in a syndication or something, they're probably, hey, I want to find a multifamily deal.
Right.
Whereas, I think industrial is great, but I just think that people aren't as, they just get a little more nervous because they don't understand it as well. But it seems
Industrial sounds dirty. Industrial sounds dirty.
it sounds complicated. It sounds like tenants and leases and financials and credit quality and, like it's not everyone's done leased an industrial space, sort of thing.
Right.
And then so office is sort of just persona non grata. And then I think, I'd say retail is probably number 3. Once again, I'm just putting it out there what you guys think. Because I mean, when we build this tool, I mean, it's non-zero effort, right, to add each new asset class to our system. I mean, it's not a ton of work, but I'm trying to think through which types of deal are people having presented to them that, having the analyzer makes the most sense for. So I'm thinking multifamily, self-storage, probably mobile home parks are probably up there too. And then
Yeah.
retail, industrial.
I
I don't know.
agree with you, Lance. So, if I'm kind of in the same camp as you, so invest in multifamily, and now because it's kind of, I don't know, not making sense, rotating it to probably self storage. And listening to this call, honestly, Guy, you've been very educational in terms of what to look for and everything else. But I actually did reach out to Van West, and so I'll probably schedule a call with them. But even in our conversations in the last few weeks, it feels like it's cyclical, right? So I need to rotate maybe because I was trying to look for something that makes sense in multifamily, and maybe this is just not the right season. And so I need to maybe look at other asset classes that make sense, that are still cash flowing, that has not been affected as much as, multifamily, in terms of maybe having a fixed interest rate in place where, the rental rates have not really been affected, and it's still, there's a lot of runway still. So I think self-storage for me would be probably a next asset class to look at. Mobile home parks. I talked to some people and they're like, maybe because we're in California, mobile home parks in general probably has a stigma. And so even like talking to some people here, like, I don't know, this is, but I was like, you're not operating it, right? So as long as the numbers make sense, I think that makes that we kind of have to go wherever the profit is, I think, and wherever it makes sense and people are renting. I totally agree with you, Lance, in terms of industrial is a different asset class that requires, I think, more sophistication to understand versus just, self-storage that most of us have used. And it's like just a box. You're not dealing with tenants really on a day-to-day basis. The liability is probably lower. As long as there's demand, I think it makes sense.
Yeah, I agree. So, and Guy, what you did for us, I mean, this is what I just forced you into, and you didn't know you were signing up for that. But you just did what when I talk about the master class, that's what I'm talking about.
Yeah.
So you take, and I'll send you the recording of this just so you have it. Cause see, I mean, that's all a presentation really is just answering.
Right.
It's just answers to questions, right? So, um, it's super powerful. Like when you take it and you share it, cause that's what you're doing to me. You're like, Lance wants to know, right? So you're teaching me, and I did. I want to know. I want to hear from you how you see it. But you put that to slides and record that for prospective investors. It's super powerful because
Right.
anyone that's on this call, if you had any question, the guy knew what the hell he's talking about with self storage. It's been removed, right? Like,
I can see that.
you know what I mean? Because you know it. And it wasn't hard for you. You didn't have to stammer or, like,
No.
you know the answer because you know it. So, and so that's why I recommend that people do that because it's the easiest way to get in to generate content. Because if you waxing poetic on self-storage for 60 to 90 minutes, every little soundbite, that you can pull out of that of you just sharing those things is now stuff that you can reuse and post on social and you didn't even have to think about it.
No. Yeah.
So I think it's super powerful and I just think enough people they don't anyway, it's sort of it's a bit of a cheat code, I think, because the issue they have when people are trying to be really deliberate, like many people think LPs are stupid, right? And so they're just like, they're just not very smart. So we need to treat them like they're second graders.
Right.
And, but there's some things that are lost in translation where I think don't think that, think more highly of them than, I mean, these are smart people. Now they might be overwhelmed by all the information. That's okay, right? Because it's easier for us guys that are in the business just to say and demonstrate our expertise with big words and, and maybe make it more complicated than maybe it is or whatever. Um, but it just, they'll figure it out. Even if it's like they only retain 10% of it, they're still even going, wow, they really know their stuff. Whereas if you try to give me the Fisher Price Duplo block version of self-storage, I still wouldn't know if you actually knew your shit or not.
Right. Right.
Right. So I think it's the cheat code because it's just easier to do because you're uninhibited.
Right.
I'm trying to I was telling these shopping center guys, I'm just trying to tell them like, be you guys are just nerds. Like, and you just like it, but it's okay. Like, I'm just giving you freedom just to go nuts and go as deep as what's comfortable for you. And we'll figure out how to ratchet it back. Right. And take some stuff and soften it and maybe, make more Duplo block, level thing. It's just easier to get your mind wrapped around. But, it's hard to go and I mean, that's why people that are professors that are teaching the PhD level, I mean, there's a reason why they're teaching, potential PhDs and not teaching the third grade.
Right.
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 They couldn't do it. I mean, like it just doesn't work for them. They know too much. The third grade teacher just has to know everything. You can be in the sixth grade and teach a third grader.
And all you need to know is what you're teaching next week. That's all.
So
Hey, I think Lily, there was something I wanted to say that maybe will be useful to you in your thinking about different things. Because you said as long as the numbers make sense. So like when you're talking mobile home, like there's a clear strata differentiator in mobile home. Like there's great mobile homes, the nice green grasses, nice rock, nice driveways, like super nice. Like you would want to live there because they're really that nice, right? Like that's one type of. And then there's the other mobile home parks that we all think about, which is like, do you have all your teeth because you got in a fight or because you do meth? Like, which is it? I'm not sure which one it is, but I don't want to live here, right? Like those are the difference. The the strata differentiator between B and C in mobile home is huge compared to B and C in multifamily or B and C in self storage. Like it's a massive differentiator. Just make sure.
Well, and the other thing is we always say how important the sponsors are, but it's even more so in mobile home parks because it requires because even like the really, really nice mobile parks, which are few and far between, it's mainly B type stuff or what we would all in our own minds think of
Right.
B. It requires the operators and how they go about executing that strategy. They can lose a park really quick where they just piss everybody off and it's an uphill battle. And that's like amateur hour.
Right.
The guys who are really good at mobile home parks, what you want to look for, what I've found in just talking and seeing the guys who are successful versus those who, somehow messed it up is just they're deft communicators. Like they understand humans at a different level
Right.
and they know how to go in and not lose the community, how to win them over, how to, right? Like, because that's the issue with mobile home park. I mean, I grew up in mobile home parks. So it's like you're so close there. Everyone knows, everyone's talking to each other. It's like there's just this thing. And if you get piss off the wrong person, next thing you know, they're just going to rebel against you and
Right.
winning them back. And um, so to me, operator is super important. That's why I told you guys about 5210. I mean, these guys are amazing, but it's because they get that. They get how to go in,
Right.
win them over right away, do things, they only do improvements that people actually want. They don't just do shit that they think they want,
Right.
and things like that. So, but yeah, when you have a great operator with the right, buying the right mobile home park, it, they can do well. Great cash flow, but
I have a question for today that I want to ask you guys. In terms of like multifamily or self storage or just alternative asset investment news, what are some good sources to kind of read and be abreast of?
So as far as self storage goes, there's a guy by the name of Scott Myers, right? He created and has been a top educator in the country for a long time. He's got maybe 150 podcasts. And I'd say like the first 50 of his podcasts that he did are all like self storage 101,
Okay.
right? So, I mean, he's a great, like, I know Scott pretty well. I mean, we're part of the same mastermind groups. Um, he, he's a big proponent of sponsoring. So like this picture right here is where we're in Mexico building a house for the indigent there, right? Scott's done probably 16 or 17 houses so far. He's a solid dude, and he's got a great heart and a great philanthropic heart, and he's a sharp operator. Been through a number of different cycles, right? Of stuff. So he's a good source for education, right? Just for information, right?
Yeah.
Um, so I
Perfect.
don't.
Yeah.
Yeah, he is Scott Myers podcast.
yeah. But news wise, I don't know. Like I follow like Real Deal, just to keep the finger on the pulse. But yeah, it's hacking. There's not like a great source of. I mean, obviously, I read the Wall Street Journal every day, and which I think is smart. Is keep abreast of the way things are pointing, and so those are. That's all I do. I mean, Real Deal just for real estate news, just to kind of see what's going on. But I haven't found anything that's really great on. It's anything of that's helpful. I think the Wall Street seems to do it for me. It's just knowing where interest rates are going. Pick stuff up that way. But
Yeah, I have Wall Street Journal subscription also. And the other one I just started literally as of a week or two ago is called Multifamily Dive. It's okay. It's general, but I'm like, you hear these deals about foreclosures, and I don't really hear about them until I watch this one guy. Anyway, just following him, and he's like, yeah, these are the foreclosures coming on, and like this is so educational. Like, where is he getting the news?
Yeah, I know. Yeah, exactly. Yeah, some of those guys follow those trackers and
There in California, Lily, there's a guy by the name of Bruce Norris,
Okay.
right? Bruce Norris would be a good guy for you to follow, especially in the Bay Area, right?
Mhm.
Yeah, he's a good guy to follow, right? Bruce Norris. He's a quasi-economist, hard money lender, California investor, been there for 40, 50 years. Like the guy is dialed in, right? And especially if you're in California, I mean, he's a good source of California news.
Awesome.
Who is
I'll look
that?
into
Who is
this.
that guy?
Bruce Norris.
Bruce Norris. Okay.
Just think Chuck's brother.
Does he have a Is he like a newsletter guy or a podcast or what? How could I?
Yep, podcast. Just look him up, Bruce Norris. He's got a podcast in there. I'm sure he's probably had Scott on there. He might have had Scott. I don't know, but I mean, like from like there's a number of groups I'm involved with, and he's come and spoken to us like face to face as a keynote speaker. Like you get to rub elbows and see what they're like off camera, and the guy's like if I was in California, I'd be following that guy about California. Like he's dialed in, right?
Yep.
Right. So he's the guy I would recommend heavily.
I have one smaller, I guess, a related question, Lance or Guy, whoever can answer it. So when they're investing into my fund as an LP, are they getting a piece of the tangible asset? Or they just, they are investing as a member interest into my fund, but ultimately my fund is investing in the syndication. So in essence, they are owning a piece of a tangible asset, right?
indirectly. I mean, they when you trace it through, they have a claim to. Yeah, I mean, it's equity, but I mean, it's not like they're on title, right, or anything like that. I mean, they're just going to be.
I'd be careful. I'd be careful about saying that they own the asset.
Yeah.
It's like saying I own the Microsoft office building that is their headquarters because I own Microsoft stock. Like that's not true. Technically, yes, there's a connection to that. Like so
That's a good analogy. Yeah, it's just
So
more. Yeah.
So how would you answer that question? Like, do I own these assets? Like, what would be the technical definition or
I
how?
would say that you do by virtue of your, you do by virtue of your that you're a partner in an entity that has made an investment in another partnership that has a claim to that, and so as far as and this is where the LLCs and the partnerships, like from the IRS's perspective, you're getting the economic benefits that are passing through to you as though as though you yourself had 100% ownership of the entity that did control the asset. So that's
I think I'd like to understand why they were asking the question. Right? Like, I mean, like people who invest with us and they syndicate a deal, they don't own the asset. They own units in an LLC. They own shares, right?
that owns the asset.
But they like to be able to go touch the building that they're invested in. Like that's when they ask me that question, I'm like, you can go touch the building, right? Like it's there. That's where your money's at. Like where it's at. So it depends on why they're asking the question. If they're looking for the economic benefit of ownership, absolutely they've got all of that. But if they're actually looking for, am I on the deed? Do I have a deed position on this deal? Which I do get that question. The answer is no. You don't have a deed position on that land,
Mhm.
right?
Yeah, and that's why it's like you're a limited partner because even in these cases, like, Guy, you invest in one of Guy's deals, and he's the manager of the entity that owns all the equity in the entity that borrowed the money from the bank.
Right.
Guy's the one who controls the decision making. So if anyone kind of owns the asset, it's probably more the manager,
Right.
right? Because they dictate, they dictate what they do to it, whether they're going to renovate it, or they're going to increase rents, or they're going to sell it, or they're going to, so that's that's that control issue, right? So it's the person who controls it is closer to the one who kind of owns it. But ultimately, these things, the partnership, it's just, they don't control it.
Would it be accurate to say that, my fund invests in tangible assets? I guess that's what
Yes. Yeah, most
yes.
definitely. Yeah. Yeah. I mean, that's what the things, and all that, ultimately, all the proceeds of the investments that you make are in one way or another, you know, tied to a tangible physical asset, right? Versus a startup, which is just, I mean, once it gives
Sky.
you property or it's blue sky or some service business. And that's what I say. Service businesses, like, your assets walk out the door every night. They're your employees. There they go.
Right.
Right. Like, if you're renting, it's your, so it's, yeah, that's how I'd phrase it. It's more the economic benefits of ownership. And yeah. And in that regard, it's like owning stock of Microsoft. It's like, yeah, you don't have a claim to, hey, that's my building there. It's like, no, I mean, I own the company that owns these assets. I own a part of the company that owns these assets.
Yeah.
Because that's what it is.
Yeah. And
So
if that's what you're trying to say, then I would definitely say you can drive there. Like we drive there. We can put our hands on it. Like this is where our money's at.
It's
Right?
real. Yeah.
yeah. Today at Connected Capital, they rolled out the membership platform that Lance, we were talking about last time. I'm debating whether to join or not. It's not significant. I mean, it is something $200 to $300 a month, paid up front for a year. I think the value is there. Probably will join. But my question is, one of the deals that they present today was by a multifamily group called Colonial Hills Capital. And it looks like they've been around a little bit. And it's actually a co-GP deal. And it looks really interesting to me. It's sort of a yield play. They're buying it, in place cap at 6.25 or something like that. And he thinks it's just gonna, it's gonna compress and it's a light value add of increasing $100 per door. And so they're just gonna, turn it around in 2-3 years. It's a 5-year plan. But once the rates come down, that's kind of their exit plan. One is this an operator that you're familiar with? And two, um, is that a viable business plan?
Yeah. I would have to look at it deeper. I don't think I've never met Colonial Hills Capital before.
They've been around since 2008, apparently.
Colony Hills Capital.
Yeah, Colony Hills Capital. The guy who came, yeah, it's
It's a New Jersey deal, right? You're referring to the New Jersey deal.
it's a what?
It's in New Jersey. The deal is in New Jersey.
In New Jersey, that's correct. It was presented at Connected Capital. I don't know if you were there today.
I was there. Yeah.
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 I know.
It looks pretty interesting, and I have not seen a deal like that at CoGP. And one of the guys said was because they're doing a REIT or something where they need a 10% GP investment, and they probably don't have it or trying to raise it. And they're putting in 3 million, I don't know, 16 million or something, and so they want the rest of it from a CoGP structure.
So
I see. So the
generally,
coaching fee offering, it's you're coming in on the 10% side, and they have an LP that's going to put up the 90.
They have 2 outstanding loans. Family offices as well as senior debt, and a second one, and then the 10%.
Yeah, I don't know. You'd have to forward me the OM. I don't know. It sounds a bit more complicated. Not that that's bad, but
no. Basically, for the fundraisers, they give the cut from the GP pool. That's what you said. Like a co-GP means that's how they sell it. Even I do the same thing. So
sell it as co-GP. So
yeah, when somebody raises the funds, right? There are 2 aspects of it. From SEC point of view, they have to have a co-GP role or a broker-dealer role, right? Without that broker-dealer license, without that, you cannot raise funds.
Oh, well, I don't like it. So I don't, and I don't mean no offense to you, but I don't like that. If that's what they're saying, is that there's going to be a bunch of you that are coming in to an entity, and your whatever vehicle you invest in will be a co-GP, and there's going to be like 30 of you on the deal.
Yeah. That's why they said passive co-GP. It means basically we will give the price cut to cover the SEC aspect of it.
Yeah, I'd have to get more information, but it sounds fishy to me. It's not like the fishy part is just, I mean, obviously if you're just coming in as an LP into a management entity, that's then turning around and investing into the deal, that's fine. But if it's like, it's some way of, I need to see it.
Yeah, in our case, we don't have the passive co-GP, but they are co-GPs, but they can opt a lower activity in the overall syndication. Like if you are doing a day-to-day asset management, they can be like investor relations
Oh yeah, and
or
I'm
something.
fine with that when you can substantiate that the roles of the general partnership are,
Yep.
this person's this. But I'm saying you get to like 6+, now you're running out of roles. And I've seen guys do that. Where like, well, no, yeah, you're investor. You 12 people are investor relations. It's like the SECs see right through that. They'll be like, no. And I guess the main thing is just that it's anyway. Like I said, it's the devil's in the details. But
Thanks a lot, Guy. I learned a lot today. Yeah.
all right, we'll see you guys. All right, thanks.
Thank you.